Head of Research with Citi India. Let's connect with him. Surendra, good to have you back. So nice to connect with you again. While we can look at India, Surendra, and say, okay, we are enjoying a great and a vibrant bull market, the grain of the truth here is that global markets are also in a fine fettle. So do you think more than strengthen local equities, it is the global equity phenomenon which is what we need to focus on?
Yeah, so Nikhil, thanks for having me on the show. So a few points to keep in mind there, right? So while global markets are doing well, at a headline level, I think you will also find a lot of uh, literature coming out on the lack of width of the market, right? It's the AI phenomenon which is driving the markets in the US, and it's like very concentrated in a few stocks. So again, a lot of debate going on all over. But in India, I think the theme continues to be more domestic, we believe. It is a combination of the macro, which is very supportive. Earnings growth last 4 or 5 years have continued to be strong, and even today, like we just put out a note yesterday, earnings revisions are in the positive territory. Uh, and of course, domestic flows have been an important variable, because even if you look at the first 6 months of this year, domestic institutions have deployed a significant amount of money, almost $30 billion into the market. So I think it's a lot domestic in nature, and that's what, in our view, is driving the markets more. And even from a flow perspective, it's been all about domestic flows and not as much about foreign flows so far this year.
Surendra, so as we look into the future, and I distinctly remember you once told me that there are two sectors which always surprise and disappoint. One is banks and second is metals. So let's look at the outlook for both these sectors.
Yeah, yeah. Sure. So I think on banks, what we are going through right now is a bit of LDR management. And again, different banks have different strategies. I think that's what we have seen from the business updates that have come out so far. So there is clearly a bit of a slowdown as far as the earnings trajectory is concerned. So when I look at this year, our analyst is building in a modest high single digit growth, which is not bad on its own, but compared to the sector's trajectory, it's slightly on the lower side. Having said that, if you are thinking about the sector from an investment perspective, that's the only large sector in India which has great metrics, and valuations are in line of like to historical median levels, right? While rest of the market is significantly higher. And you could plot sector by sector valuations and see where financials stand in the context of history. So the investment view may be different, but yeah, in the near term, I think there is a bit of a slowdown as far as earnings growth is concerned. On metals, I think it still remains a fairly volatile sector. I would say stocks have done well, the sector has done well. But then again, China historically has been a significant driver. And at least there, it still feels like things are quite mixed. So we continue to be cautious as far as metals are concerned. In our sectoral strategy, we have an underweight view on metals. And I think China will continue to play a big role in terms of the outlook for metals going forward.
Nifty target or June Nifty target is 24,400, and we're looking at June 2025, and which is where we right now are, broadly, plus minus 500 points. So are you making a case that for next 12 months we are in a period of absolutely no returns?
So see, a couple of things to keep in mind. I think we have had very good returns over the last 12 months. We are up 25, 26%. If you look at calendar year to date, we are up, say, give or take 12% or so. So we have had very good returns. I would say slightly ahead of the earnings trajectory as well. So to that extent, what we are expecting is a bit of a consolidation. There are a lot of variables that the market will really watch out for and digest in the next month or two. Be it the earnings, where we do see a little bit of a moderation as far as the quarter is concerned. Secondly, the budget, again, that I think the market will be watching out for, monsoon trends. So a lot of variables to watch out for, and which is why we are expecting the market to consolidate a bit. And what we put out in our note yesterday also is that we would be buyer of dips. And again, I think what is also important is the earnings revision cycle. It's been very supportive pretty much over the last year or so, where earnings revisions have been positive. So I think this earnings season will be important to see if that also sustains. So there are a lot of these things which we are watching out for. And in the near term, we feel that the market may consolidate till we get clarity on some of these things going forward.
You is cautious on consumer discretionary, yet it is constructive on consumer staples. So from a market standpoint, can I say time to buy FMCG and avoid auto?
So a couple of things there. See, I think you have to keep a couple of things in mind, right? See, firstly, autos have had a great run over the last couple of years. We have seen everything coming through. Growth has been strong, margins have expanded. So to that extent, we do see a lot getting priced in. Okay, and to like going forward, that's the reason we think even the earnings growth may be a bit limited. Like for this quarter, if you look at the earnings growth expectation for autos, it's moderate compared to what we have seen in the last 4 or 5 quarters, and that's to do with how well the sector has done and where margin levels are. While on staples, the challenge that we face is that while growth is starting to recover of a very slow level, so there is a bit of a gradual recovery as far as growth is concerned. But then when you look at 1 year forward valuations across all the sectors, it's still the most expensive sector with valuations kind of touching or approaching 50 times 1 year forward. So that's the reason, even on staples, we think that the upsides are relatively limited. In our sectoral strategy, we have a neutral kind of a weightage as far as staples are concerned, primarily kind of balancing out the moderate improvement in growth versus the already high valuations that the sector commands.
What role do you think domestic liquidity will play? I mean, there is 25,000 crore of flows, which in a sense, they look like committed flows for next couple of quarters. So while we may talk about, okay, markets are not cheap, but if flows are there, the bids will ensure that prices go higher. So what role do you think that will play in the overall scheme of things?
Yeah, so see, the way to think about it, take a slightly more longer term view, I would say, right? So if you go back a decade or so, say 5 to 10 years back, the market valuations typically used to be in the range of, say, 16 times 1 year forward, give or take. And we also used to see a lot of volatility because the market from a short-term perspective would also be determined by the direction of the FII flows, right? So in a year when we got a lot of outflows, the market would have seen a correction. What has happened in the last 5, 6 years, what we have seen is firstly, the volatility has come down because every time there have been foreign outflows, we have seen the domestics kind of stepping up and buying. Secondly, from a market multiple perspective, the market multiple on an average has moved to more like 19 times or thereabouts in the last 5 years, while today we are trading at around, say, 21, 22 times. So I think those things have definitely changed, and I think the market has become a lot more balanced from a flow perspective. I remember, like maybe it was more than a decade back, the ownership of the market when we used to look at it, say BSE 500 or one of those broad-based indices, foreign institutional investors used to own roughly a quarter of the market, while domestic institutional investors used to own around 10%. Today, both those numbers are broadly equal at 17, 18%. So to that extent, I would argue that the market is more balanced, it's de-risked a lot more, and to that brings down the volatility and also helps the market multiple. So more medium term, that's how we think about it, and it does provide some kind of a support. When say for example this year in the first 4 or 5 months we saw foreign outflows, but yet the market has continued to see a nice move up.
Chances that we could see a situation of no sellers at all. I mean, domestic flows are strong. Foreign institutional investors decisively have come back after the election verdict. So when technicals are at play, markets will lose sight of the right valuation benchmark. Could we go through that phase?
So see, there are a couple of things I would say again, right? So you also have to keep in mind the primary market activity, the number of blocks being done in the market, and so on, because those have also increased. And to that extent, while domestic flows might be coming in, a lot of that does get absorbed in those as well. So that I think is another angle to consider when you are thinking about the flow dynamics, both sides, right? How they are coming from and where they are getting deployed. So that is one thing you have to keep in mind. But yes, in the near term, it can always happen that you could have a period where the market trade higher, sectors trade higher. We have seen it many times in the past. So while you take a very long-term view, the market returns are not very different from the earnings growth profile. But in the short term, there can always be deviation based on all the factors that you spoke about.
Surinder, in terms of multi-year trends, what are the multi-year trends according to you? Is it like, I'm just drawing it for our viewers here. When I say multi-year trends, financial inclusion, EV, energy transition, what are the multi-year trends according to you?
Yeah. So there are in India, the good thing is if you look at the from a secular trend perspective, there are actually a lot of them going on. Okay, and the pace may vary depending on where we are in the cycle, where we are in the maturity curve, etc. But across the board, you can kind of pick it sector by sector, and you could see that there is a trend in each sector. Right, you take say I think some of those you already mentioned, so I'm not going through that. EV is very visible, and it is picking up as far as the auto space is concerned. Right, you look at the capital goods, defense sectors. There is a big push towards both, firstly, government spending, and then from defense perspective, indigenization. So there is a big push towards that. You look at the IT sector, right? It's been like a very secular story. Now, again, because of the maturity, the growth might have slowed down a bit, but it still remains a secular trend. Indian IT is still growing well ahead of the market. And then you have the global capability center story within that, where again you have seen very strong trends, and which obviously are very beneficial from a country perspective. In the energy side, renewables continues to be a big focus area, and again, growth has been very secular in nature. So you could kind of go sector by sector. We actually put out a very detailed note last year where we argued that India has a lot of secular opportunities, right? And again, like we didn't discuss, say, for example, healthcare. Healthcare still remains like relatively low penetration, lot of room. Insurance, a very similar story. So I think there are enough secular stories in India, okay, where and which is why we think that the market is it throws up a lot of opportunity for global investors to come in and invest. The decisions may depend on the near term cycle, valuations. A lot of those factors come into play, but I think from a medium term perspective, it's a lot more secular. And what that also does is it makes the market very interesting. Because yesterday I was like looking at one of the other emerging market Asia markets, right? The largest stock there is like a very big part of the country's benchmark. India is a very diversified market with a lot of stocks having a lot of liquidity and being a play on different secular themes. So overall, I think there are enough opportunities and enough secular themes for investors to really choose from when they look at India as a medium-term opportunity.
Data point which I always look at and world looks at is your market cap to GDP ratio. Indian financial markets are trading at a premium to the real economy. Historically, when that has happened, that also has been a red sign. Is that a number which institutional investors look at it? Because Indian financial market right now, for the benefit of our viewers, I'm saying that number, they're trading at about 1.2 times the real economy.
Yeah, so you could look at the matrix in different ways, right? In some ways, some people focus more on price earnings. Some people will look at market cap to GDP. So there are all these measures that people look at. And I did say that India is trading higher than what it usually trades. When you look at even the broader multiple of 21 times 1 year forward, it is higher than what we used to trade, say, 10 years and 5 years back. So you have to kind of step back and think, is there a valid reason for it? We think that there is definitely a reason: the favorable macros, the good GDP growth outlook, and it being well ahead of other emerging markets, the earnings outlook. There are a lot of those, and the domestic flow story, which you already alluded to. A lot of those factors are at play, which allow the market to trade higher. Now, it's always going to be a debate, and it is going to be subjective on how much higher, right? So if earlier the market used to trade, say the 5 year average is 19 times or 10-year average might be 17, 18 times, then is the right multiple 21, 22? I think it will always be a matter of debate. And I think it will also be a function of what opportunities do people see in other assets. Like if you're looking at global investors, then the opportunities in other markets. If you're looking at Indian investors, opportunities in other asset classes. So I think all of those are going to be at play. So the way I would put it across is there is a reason for the higher multiple. How much higher is always going to be a matter of debate.
Surinder, in the light of where the government policy action is moving, are there any specific market expectations from this year's budget in terms of a tax change or no change?
Yeah. So I think again, it's we have not really put out a detailed note on it yet. So just kind of keeping it at a top-down level. I think there are two, three ways to think about it. Firstly, from a government's ability to do things perspective, I think they're in a very comfortable position. So to that extent, if you look at the last 10 years, there has been a huge focus on infrastructure, like anything to do with public capex. So that focus, I think, will continue. I think there is room to do a lot on, say rural land and consumption. So I think there is a lot of room to do on this year, for example, given where the government's finances are. So things look pretty comfortable from that side. In terms of some of things like tax rates, etc., I think very difficult to comment at this stage. It will depend on what their immediate priorities are. But overall, we think that things are they are in a fairly like comfortable position, and the medium term focus on infrastructure, public capex, etc., that should continue.
Are markets prepared for any change in long-term taxes? Is that something which could come as a knee-jerk reaction, or that is something markets will digest eventually?
And the way I would put it across is it's a topic which has been discussed, right? So even I remember before the elections when we were meeting investors, this topic was coming up in a lot of meetings. So to that extent, people are aware that something like that could happen. So I would say a lot of meetings, this has come out as a point. In terms of how much, how it will get priced in, etc., it's always very difficult to speculate because it totally depends on what exactly comes through and what form it comes through. So difficult to comment on that, but it has come up in client discussions. So, say I would say over the last 2 months in a lot of these discussions.
Everything, and we've not discussed perhaps the hot favorite, which is PSUs. And PSUs can be divided into metals, banks, defense, railways. What is your pick there?
So see, we have liked PSU selectively. If you look at some of our top ideas, they do fall under the energy space. And again, the short-term views may be different, but we continue to like quite a few names on the PSU energy side, PSU utilities side. I think all those names we continue to like. See, our view on PSUs is that wherever you see a good medium-term growth outlook, okay, today investors are looking at those stocks quite favorably. And while we have seen a nice re-rating, but valuations across the market have re-rated and those stocks have also re-rated. So the bigger issue is the visibility of medium-term growth. If that visibility is there, then I think those stocks can continue to do well. And again, I can't talk stocks specifically, but if you look at some of our picks, they lie in, say, PSU utilities, then in the PSU energy space, okay, then defense as well. So those are broadly the sectors where we like the PSU space.
Okay. How would you guide our viewers to urge to navigate in IT? One side I see a success of Nvidia and AI. Then I see Indian IT companies. Either they are not understanding or they are in denial because they tell us that they are still relevant but business is not there. Growth, GDP is growing at 8%, their business is growing at 4%.
Yeah. So, see, I think you mentioned a good point, right? You mentioned the AI players, right? And even in the US, if you look at the enterprise services space or enterprise software space, the trends have been pretty muted, right? You look at the US IT services companies, which are direct competitors to some of the Indian IT companies, those stocks are down fairly significantly this year. Okay, so the trends in enterprise IT spending have been a bit slow. And I think it's not only about the macro as a lot of people make it out to be, while there has been macro uncertainty. But at the same time, there are a number of other factors that play in our view. So, firstly, you have the issue of incremental IT spending. Where is it going to? If a lot of it is getting to diverted to AI related spending, which is benefiting the semiconductors and cloud companies at this stage, then how much is really left for the services companies, for example? Secondly, we have seen a big explosion, a big growth as far as the GCC space in India is concerned. Post COVID, in the last 4 years, we have seen a very significant kind of a growth in the GCC space. So now again, there is a big debate on how much it takes away from the IT sector, but essentially it's a play into the same overall IT budgets of enterprises. Okay, so that's the other thing which also one needs to keep in mind. So overall, like our view remains, like we have been cautious on IT services for a good 2.5 years, and our view remains that the outlook is slow, and there have been disappointments, and we think that will continue because the market is still kind of pricing in a fairly sharp recovery. And as long as the numbers keep on getting downgraded, it's like very difficult to see the stocks working. So that's on the growth side. And even on the margin side, I don't think it's as easy an outlook as some people believe. Because firstly, a lot of growth is coming from the cost takeout deals, which are generally more competitive. Okay. And secondly, a lot of margin levers which were there a year and a half back have really gotten utilized. Utilization has already gone up, subcontracting has already come down, and so on. So our view is that IT is still going to be tough. Growth is still going to be slower, and it may disappoint the street. And that is the reason we have a cautious view on the IT space.
Where do you mind right now markets are overestimating growth, and where do you mind markets are underestimating growth?
Yeah. So see, it's a I would say it's a tricky market because in terms of overestimating and underestimating, like I mentioned, IT is one of the sectors where we do believe that there could be some downgrades. Okay. If I look at some of the other sectors, like if I look at financials, right? I think 6 month view could be very different from a 2 3 year view because the way the market is pricing the stocks today, it almost feels like that the market believes that growth could be slower for longer, which we don't believe in. So we think that is an area which medium term will grow faster. Now, then some of the stocks where market is pricing in higher growth, like industrials, infrastructure, etc., we believe that they will continue to be high growth. Now, again, they don't necessarily need to surprise because there could be a good earnings compounding story there. So then, like on the pharma side, generic pharma, that's one space where we think that because of the good outcome in the last 12 months, the market is kind of extrapolating and pricing in too much. There were reasons why growth was better. Okay, there were some disruptions in the sector globally, etc., which we think is kind of gradually going to reverse. So growth in pharma might slow down a bit versus current market expectations. Again, telecom market is expecting good growth. I think that should come through. That's how I would really put it. I think staples is one area, but market is already pricing in a recovery. So to that extent, very difficult to see surprises. But yeah, the growth trends are gradually improving.
Really appreciate your time and so glad you could join us. Ankur Rudra joins us, Executive Director with JP Morgan, looks at.
If you like this video, then like, share and subscribe to ET Now.